Hello and welcome to Business Incorporated, live to you on Channels Television, broadcasting from Lagos. I am Bolaji Akinwale. Coming up, Nigeria agriculture sector is slowly on the move. Global stock markets react to ECB quantitative easing extension. And we'll take a look at the domestic fixed income market. We'll begin with Nigeria Senate holding stakeholders' public hearing on trade and investment issues, and that is to come up next week, Tuesday. The hearing seeks to repeal the Consumer Protection Act and in its stead establish a new Federal Competition and Consumer Protection Commission, as well as Competition and Consumer Protection Tribunal. In a notice published today, the Senate public hearing will also push for an act to scrap the Nigeria Export Processing Zone Authority and replace it with a new Nigeria Development and Zones Commission. The public hearing will also look at new measures aimed against trade in counterfeit goods and protection of copyrights and trademarks. And Nigeria's agriculture sector is slowly on the move, benefiting from a number of areas, including the continuity of government policies. This was according to an investment note released on Friday by investment and securities trading firm FBN Quest. The report says the country's agri sector was probably brighter spot in the otherwise dire national accounts in the third quarter. The sector expanded by 4.5% year-on-year. Analysts at FBN Quest says they've identified enough encouraging pointers to be confident about the years ahead for Nigeria's agri sector. The pointers include central banks' increased financing, the anchor borrowing program, the 1 trillion naira planned fresh capital into the Bank of Agriculture, and large-scale planting of cashew seedlings, wheat milling, and poultry. It's time to take you to the market. Now we'll begin from Europe, where the numbers were mixed after the European Central Bank announced an extension of at least 9 months of its massive bond buying program, although at lower monthly amounts. Olaf Krieger is DWTV's financial correspondent reporting for Channels Television and is joining us from Frankfurt. Olaf, thank you so much. Now, talk to us about the morning after ECB Draghi's extended quantitative easing program. Is the market's rally still holding up?
Well, I have to say the rally is at pause at the moment, and there are also some profit-taking here in the market. That's why you can see behind me German top shares are still in positive territory, but this is actually right now not a rally after the ECB decision came out yesterday and to extend the stimulus just to solve so many problems in the Eurozone. But I also have to say there's kind of criticism here in the market because some analysts say it needs more than stimulus. It needs more than quantitative easing. It needs, first of all, structural reforms here in the Eurozone, especially, of course, in Italy, and that might help, because the question always is what is the purpose of all those measures, and what can Draghi finally do to get those economies back on track. So, but for the moment, for the time being, and especially on this Friday, traders and investors are quite satisfied with the decision coming from the ECB yesterday.
Now the crude prices rally seems to be holding steady above $50 per barrel as all eyes turn to non-OPEC Russia and Oman to shave output. What sectors and specific stocks are enjoying this rally the most?
First of all, of course, shares of oil companies all over Europe, because probably this very long period of time of this extremely weak oil price is going to end, and Russia plans to meet with some OPEC and some not OPEC nations on Friday before wider talks in Vienna about the oil price. So OPEC member states and non-OPEC member states are obviously trying to find some ground just to stabilize the oil price, which is remarkably weak over weeks, over months right now. But we also have to keep in mind that there's still too much oil on the international markets, and this oversupply situation on the oil markets is still a big concern, as one trader pointed out here at the Frankfurt stock market. And by the way, there's also hope that the international sanctions against Russia could be lifted, because there are obviously a new relationship between the US and Russia.
Now, Olaf, it's been an interesting trading week with a raft of economic data and the ECB. Now, what other rallying headlines are on tap as the countdown to Christmas continues?
Well, after the ECB decision is right before the next decision coming from the US Federal Reserve, and Janet Yellen will surely raise interest rates in December. That's what traders and investors here at the Frankfurt stock market expected, and no one knows which economy strategy that President-elect Donald Trump is going to follow. So no one really knows which efforts and which succeed the U.S. economy will have in the near future. And of course, all the problems we see here in Europe are not solved anymore. The only thing what we saw last week is that the ECB is still willing to support the economy. So it will be very exciting before Christmas.
Thank you so much, Olaf Krieger, the WTV financial correspondent reporting for Channels Television. In Asia, the markets finished mixed as gaming shares tumbled in Hong Kong, and South Korea's main index handed down before Parliament voted to impeach President Park over an influence peddling scandal. Before the vote, the benchmark Kospi closed down 0.31% at 2,024.69. Japan's Nikkei 225 finished up 1.23% at 18,996.37, notching 4 consecutive sessions of gains. Australia's ASX 200 advanced 0.31% to 5,560.62, supported by a 1.09% gain in the energy sector and a 0.98% uptake in the heavily weighted financial sector. Chinese mainland shares finished mixed, with the Shanghai Composite closing up 0.52% and the Shenzhen Composite finished down 0.35%. In Hong Kong, the Hang Seng fell 0.56% as gaming shares saw sharp losses following reports of Beijing taking aim at the Macau gaming industry in a bid to halt capital outflows. And now to the U.S. We're seeing Wall Street equities closing higher on Thursday, notching fresh record highs as a post-election rally continued following a key monetary policy announcement from the European Central Bank. Gio Malandrino is VOA business correspondent reporting for Channels Television. She joins us from New York. Thank you, Jill. Now, U.S. markets continue to trend higher as the first full week of December trade comes to a close. Tell us more about sector performance and macro data.
All right, well, good morning from New York. The market madness continued as the Dow Jones Industrial Average, S&P 500, Russell 2000, and Dow Transports all traded to new all-time highs for a second day, though this time the Nasdaq joined the party on Thursday, trading at a new lifetime high as well. The mood can be summed up in one word: euphoria. As market enthusiasm has hit a peak where buying is chased by more buying, and the main catalyst at this point seems to be investors and portfolio managers chasing performance into the end of the year, not wanting to miss out. So far, industrials, materials, and financials are leading in December, while defensive and interest rate sensitive names underperform, such as utilities, healthcare, and consumer staples have also been hit. Investors continue to be banking on Trump's policy plans to boost infrastructure spending, help revive the fossil fuel industry, and cut regulations.
Now, besides the Trump rally, what else is in the backdrop that continues to drive the markets higher?
Well, the fundamental backdrop continues to suggest very little chance for recession in 2017, as just last week, third quarter GDP was revised up to 3.2% from 2.9%. That's spurred by a strong consumer spending, which represents nearly 70% of the GDP in the U.S. Additionally, U.S. manufacturing, according to the Institute for Supply Management, that index rose to 53.2 in November, thanks to higher construction spending. Now, in the U.S., an ISM reading over 50 suggests economic expansion. So in theory, that should continue to creep higher if Trump follows through in his infrastructure spending plans. Now, this all comes at the heels of the end of the year-long earnings recession, and although we are mid-stage in this economic cycle, fundamentals continue to be on firm footing, if not outright improving. The other big positive last week was the Conference Board's Consumer Confidence Index in November rose to 107.1. That's the highest reading we've had since July 2007. So there's real fundamental indicators out there that are also lending to the stunning rise in equities since the national election here.
Now, will the Federal Reserve hike rates next week because that really is the last major catalyst in the markets for the year, assuming things remain the same?
Right. Well, traders are pricing in 95% that the Fed will take rates up 25 basis points, according to the CME. And why wouldn't they? The Fed has been very clear in telegraphing its motive and by remaining data dependent. Data is as strong as it's been since the financial crisis. Employment is nearly at full capacity, and corporate earnings seem to have troughed, and we're now on an upswing. So I think the Fed needs to hike to remain apolitical, as your guest said before, too.
Now, do you think there is more juice in this rally?
Well, the momentum has been stunning, and certainly Trump's business-friendly policies and deregulation rhetoric is helping stocks. Now, particularly the small-cap companies in the Russell 2000, they have less international exposure than the larger ones in the S&P, which derive roughly 50% of revenue overseas. At some point, there will be a pullback, and that's okay. It's a sign of a healthy market. It gives investors a chance to look for more attractively priced stocks to add to their portfolios. Until then, you trade along with the trend. You don't want to fight this tape. It's pretty strong out there. There's no need to bottom or top tick the market. It's not worth the risk of trying to be a hero by timing the tape. Certainly, Trump's first 100 days in office will be what we call a show-me exercise in terms of getting things done, and that is when I think we might see an uptick in volatility.
We sure keep our eyes on the developments as they unfold. Gio Malandrino, VOA business correspondent, reporting for Channels TV. Thank you so much. And Britain's Supreme Court begins final day of argument over Brexit and government's plans on how to trigger Article 50 of the Lisbon Treaty, which would formally start the process of divorcing the UK from the European Union. The government is appealing against a ruling last month that ministers need Parliament's consent to invoke Article 50 of the EU's Lisbon Treaty, the first formal step in the process of leaving the bloc. The government's fear is that Parliament could delay Prime Minister Theresa May's plan to trigger Article 50 by the end of March and water down ministers' Brexit strategy. And transport and services came to a halt in Greece. As workers strike against reforms, the government is scrambling to finalize with lenders that will affect pensions and labor rights.
Greeks went on strike on Thursday to protest planned labor reforms and painful austerity cuts demanded by the country's European Union and International Monetary Fund lenders. As part of a crucial bailout review, the government is eager to complete. Passenger ships remained docked at port, national and city transport was disrupted, and local administration offices shut down as workers joined the 24-hour nationwide walkout called by the country's largest private and public sector unions. A few thousand workers and pensioners rallied in central Athens, criticizing the government for bowing to lenders and expressed fears that austerity reforms would continue for many years. Turnouts to rallies has decreased due to austerity fatigue as the country is in its 7th year of a debt crisis. Eurozone finance ministers said at the beginning of the week that Athens needed to speed up the review, which has hit a snag on labor reforms, including liberalizing mass layoffs and reviving collective bargaining between employers and unions. Athens has rejected its creditors' demands for more austerity measures beyond 2018. The Eurozone also granted Greece short-term debt relief on Monday, which was hailed as a success by the leftist-led government that has been sagging in polls for months. But the news did not impress austerity-hit Greeks, who have lost almost a third of their income since the crisis started in 2009. Thousands have lost their jobs amid a deep recession. Unemployment in September stood at 23.4%. Parliament is expected to vote on the budget on Saturday, December 10.
We'll go on a break now, and Business Incorporated returns in just a moment. Please stay with us.